Hey everyone, welcome back to Corporate Decoder. Today we're digging into a filing from Solo Brands, and trust me, it's a bit like a campfire that almost went out, but they threw some serious fuel on it at the last minute. Get ready for some financial maneuvering that's kept this company afloat for now. Before we dive deep, if you're new to decoding corporate mumbo jumbo, make sure you subscribe and join our Discord channel down below. The more the merrier. So what is Solo Brands? They're the company behind those popular smokeless fire pits, along with other outdoor gear brands like Oru Kayak and Chubbies. Now let's get into the filing. This report is dated June 13, 2025, and it's a Form 8K, which is basically a snapshot of major events that a company needs to tell the SEC about right away. In this case, it's about a big change to their debt agreement. But first, a little background. It's super important. The writing was on the wall for these guys. The company's stock was actually suspended from the New York Stock Exchange back in April. That's a big red flag because it usually means a company isn't meeting the exchange's listing requirements, like maintaining a certain stock price or financial health. So clearly they had problems. Right, the main event is that Solo Brands made a deal that changes the terms of their existing loans. Think of it like renegotiating your mortgage to avoid foreclosure. They've entered something called Amendment Number 4 to their credit agreement. Basically, they're changing the rules of their loan agreement with their lenders. This amendment does a few key things. First, it gets the lenders to forgive some past mistakes, what are called events of default. Second, it shakes up how much they owe and how they'll pay it back. After this change, the company's debt is split into two categories. A revolving credit line of $90 million, which they can borrow, repay and borrow again as needed, and term loans of $240 million, which is money borrowed that needs to be paid back over a set period. To make this deal happen, Solo Brands had to pay down some of their existing debt, which they did by paying off $136.5 million in revolving loans and $32.5 million term loans. The lenders were being really nice about it and even let them pay a fee to them in two different ways, as a cash or as company stocks at $495 million. The good news is that this deal gives Solo Brands more time to pay back what they owe. They extended their maturity date to June 30, 2028. Of course, this extension comes at a cost. The interest rates on these loans are pretty high. For the revolving loans, it's either an adjusted rate plus 3.5% or a base rate plus 5.5% or a base rate plus 5.5% or a base rate plus 4.5% or a base rate plus 4.5% or a base rate plus 4.55% or a base rate plus 4.5% or a base rate and adjusted rate plus 5.55% or a base rate plus 4.5% or a base rate plus 4.5% or a base rate and adjusted rate plus 5.5% or a base rate plus 5.5% or a base rate and an adjusted rate plus 5.5% or a base rate plus 4.5%. To keep a close eye on Solo Brands, the lenders have added some extra reporting requirements. Now, they have to give the lenders very detailed reports about their cash flow, how much they can borrow, and other key performance indicators every month. They even need to deliver financial statement deliverables faster than before. There are also financial goals that Solo Brands needs to hit, called financial covenants. For example, they need to meet a minimum level of earnings of $25 million for the 4 quarters. The also added liquidity covenant, which can spell trouble for the company. If they don't have liquid assets, they risk defaulting and missing a loan payment. If the company sells some of its assets, they have to use that money to pay down the loans faster. They also need to use any extra cash they have to pay off the revolving loans each month. Remember that agreement where the lenders can receive the fee in cash or company stock. Some of the lenders chose to receive an aggregate of 4,879 shares of stocks, equal to about 5% of the company's stocks. There's also a change in leadership. John P. Larson, who had been serving as the interim CEO, is now officially the president and CEO of Solo Brands. The company put out a press release about these changes, which is pretty standard when a company's shares are publicly traded. So what does this all mean? Well, Solo Brands was in a tough spot, and this new agreement gives them some breathing room. They've bought themselves more time and adjusted their payment schedule. But it's not a free pass. They're going to be paying higher interest rates, and they're under a lot more scrutiny from their lenders now. Looking at this situation, I wonder if Solo Brands is really out of the woods. The company had to make those changes, and it does buy time to pay back some debt. Now, it really needs to deliver on sales and make some profit. One real risk is if people stop buying their products, for example. Imagine if new competitors came along with similar but cheaper fire pits. Ultimately, Solo Brands' future depends on whether they can turn things around and start making enough money to pay off these debts. up to what do you think? Let me know in the comments below. If you found this breakdown helpful, give us a like and subscribe for more corporate decoder videos. Also, don't forget to join our Discord community where we discuss companies like Solo Brands. Thanks.